Hey, small business owners, are you making some big mistakes with your small business finances? Hey, it's Bree Strickler, the Platinum Bookkeeper, and I'm here to show you 10 of the most common mistakes small business owners make in their finances and how you can avoid them. But first, take a moment to like and subscribe so you don't miss out on future tips from the Platinum Bookkeeper. Every week I post 5 short videos and a longer tutorial to help small business owners just like you not only understand their finances, but master them. You make the money, I make it make sense. All right, 10 big bookkeeping mistakes small business owners make. Follow these tips to stay tax and decision ready and as audit proof as possible. Number 1, mixing personal and business finances. This is the ultimate sin for small business owners. Commingling your business and personal expenses makes it nearly impossible to track just how profitable your business really is, and it makes tax prep a nightmare. What's more, you can also lose your LLC protection. So this one is a huge no-no. Be sure to keep your business and personal expenses separate, always, no exceptions. That means you have separate business checking and savings accounts and credit cards, and you don't make personal purchases with these accounts. Okay, number 2, failing to save receipts. You may have heard other accounting professionals say that you don't have to save receipts for purchases under $75. Well, this is a very common misconception. While your bank statement shows where you spent the money, it doesn't show what you purchased. And tax authorities typically require detailed receipts. They want to see what you purchased, where you purchased it, and the date that you purchased it. Without detailed receipts, you risk losing valuable deductions during an audit. So save all receipts. All right, the number 3 mistake that small business owners make: misclassifying workers. Mistaking a 1099 independent contractor for a W-2 employee or vice versa is a frequent error and a huge no-no. The IRS has strict guidelines in place, and they're really starting to increase scrutiny on the gig economy. Small business owners often misclassified regular workers as 1099 contractors to save on payroll taxes, but this is a risky move, and the penalties and back taxes can be crippling for your business. Not sure of the difference? A true 99 non-employee contractor doesn't work for you, and you can't control how or when the work is done. An independent contractor brings their own tools and their own specialized expertise. They likely have other clients, and they're not 100% dedicated to you. Now, if someone works exclusively for you, you supply their tools, their office space, or equipment, and you reimburse their expenses, then that's probably an employee. And according to the IRS, you better start treating them that way. All right, number 4, not understanding cash flow. Small businesses can be profitable on paper and broke at the bank, and it happens all the time. If you don't understand the flow of funds through your business, you're setting yourself and your business up for failure. Profitable businesses fail all the time. Let's say you land a massive $100,000 contract. We'll record that $100,000 in revenue. Well, then you spend $70,000 in expenses, material and labor. Okay, it's not bad. You got $30,000 in profit. On paper, you're a rock star. But here's where things go off the rails. If you set the client's payment terms at net 60, meaning that your client has 60 days to pay the $100,000 invoice, that's great for your client. But the issue is you don't have 60 days to pay the $70,000 in material and labor, and those are due right now. Well, if you've only got $10,000 in the bank, you're in serious trouble. The answer? Set your payment terms to due on receipt, or charge at least a 50% deposit to help ease the burden of payroll and materials until payment's made in full. All right, the number 5 mistake small business owners make is treating themselves like a hobbyist for salary purposes. Small business owners who pay themselves with whatever's left over at the end of the month are making huge mistakes. And this makes it impossible to track your business's true overhead, and it triggers red flags with the IRS that you may not be paying yourself a reasonable salary for the work you do. Waiting until the end of the month and paying yourself what's left over makes your personal finances as volatile as your business sales. What happens if you have a bad month? And then there are the blind spots in labor. If your business made $5,000 in profit this month and you worked 80 hours, but you didn't pay yourself your business actually didn't make any money at all. Now, this really starts to matter when your business is structured as an S Corp. The IRS requires you to pay yourself a reasonable salary via payroll as a W-2 employee. Now, if you're just starting out and you're a sole proprietor, it's okay not to have a salary on day one as you get your feet on the ground with your business. But it's not okay to have a plan in place for your salary by day 180. Your time is valuable, and you should be taking a salary, even if it's a small one. All right, number 6, ignoring zombie charges and idle assets. Small recurring subscription or app charges can bleed a business dry. $20 here, $50 there can really add up. In fact, most small businesses lose up to 2% of their revenue due to ghost or zombie subscriptions that they don't use. And in some cases, they don't even know they have. Take a look at your bank and credit card statements and scrutinize every expense. Cut the bloat now. Next, take a look at your outdated equipment. And these items may have little value to your business, but may be a game changer for a nonprofit or a burgeoning business. Can you donate them to a worthy cause and gain a tax advantage? Well, it depends on how these items sit on your books. If you've written off the full cost of the item, as in your CPA has fully depreciated the cost of the item, you usually cannot take a charitable deduction. But if it's not fully depreciated, you can typically deduct the lesser amount of the fair market value of the item or the amount that has not been written off as of yet. Okay, the number 7 mistake small business owners make: neglecting sales tax obligations. Sales tax liability varies by state and oftentimes by city. So you have to understand the laws in your area, and due to economic nexus, if you do over $100,000 worth of business or a specific number of transactions in some states, you have to remit sales tax there, even if you've never set foot in that state. Sales tax can be confusing because you have to charge based on where you're located and based on where your customer receives the product. And if you're in a destination-based state, you may be technically responsible for managing multiple tax jurisdictions in a single state. And not everything is taxable. Tangible personal property is usually taxable, although some states exempt groceries, clothing, or medical supplies. And services. Well, this is where it gets especially messy. Some states tax professional services like landscaping or equipment repair, while others only tax data processing or software as a service. Always remember, sales tax collected is not your money. It's the state's money that you're holding in trust for the state. And some states are incredibly aggressive about collecting their money. And unlike some income tax penalties, sales tax penalties often can't be discharged in bankruptcy. And sometimes the state can hold the business owner personally liable for the unpaid debt. Set yourself up for success when it comes to sales tax. Learn the rules of your state and city, and for the states and cities where your customers reside. Build an exemption vault. Collect exemption certificates for wholesalers and nonprofits, and set a policy that no tax-exempt order is processed until a digital copy of the certificate is uploaded into your system. If you can't produce the certificate, an auditor will charge you the tax that should have been collected plus penalties. And remember to file on time, even if zero tax is due in states you're registered in. Number 8, pricing too low to stay competitive. There's a lot of competition out there, but gaining exposure by pricing your services or products too low in an attempt to gain a competitive edge is a business killer. If your pricing doesn't account for your time, overhead, and healthy profit margin, you're undercutting yourself. Not only do you undervalue your services, but you attract a high volume of clients. And while on the surface your business appears successful, you're so busy fulfilling low profit work that you don't have the time or mental energy to improve your system and find those higher paying customers. This type of mindset attracts problem clients. Statistically, customers who pay the least often demand the most, and low-price shoppers are frequently less loyal, meaning they'll end up leaving you for the next discount or bargain price offer available to them. And they're more likely to request refunds or demand more of your time. Never undervalue your services by pricing them too low. Okay, 2 more. The number 9 biggest mistake small business owners make: not having a cash reserve. Studies show that the number 1 reason small businesses fail is they just don't have enough cash to sustain themselves. Learn how to calculate your burn rate. Take a look at the amount of cash it takes to sustain your business each month. If you have $40,000 in the bank and your burn rate is $10,000 a month, you have exactly 4 months to become profitable before you're in serious trouble. At minimum, keep at least 3 to 6 months of essential operating expenses in a high-yield savings account. What are essential operating expenses? These are your rent, payroll, and utilities. They don't include travel and meals and nice-to-have subscriptions. They're just the bare minimum necessary to keep the lights on and the doors open. Cash is the oxygen of your business. It's vital to the health of your business. All right, we're almost through our list of the top 10 biggest mistakes small business owners make. But before we continue, take a moment to like and subscribe so you don't miss out on future tips from the Platinum Bookkeeper. All right, the number 10 biggest mistake small business owners make: developing superhero syndrome. Small business owners often make the mistake of thinking they can do it all themselves, trying to be the CEO, sales manager, IT professional, marketing guru, and CFO simultaneously. This often leads to decision fatigue and financial errors that make for very expensive mistakes. When you fall into this psychological and operational trap, you become the ultimate bottleneck. If every decision from a $50 refund to a $50,000 contract has to go through you, your small business can only move as fast as you think. And even the most talented small business owners are only truly elite in one or two areas. Understand your limits and be willing to outsource the areas of your business that you don't function at your best in. It's not about control, it's about the success of your business. And if you employ others, it's about your livelihood and theirs. That's it, the 10 biggest mistakes small business owners make. Have you been making any of these 10 mistakes in your small business? It's never too late to right the ship and to learn better tactics. Head on over to theplatinumbookkeeper.com for a free consultation to learn how better bookkeeping and the Platinum Bookkeeper can make your money make sense. I work one-on-one with all of my clients, and your books are never passed on to an apprentice or a junior bookkeeper. That's my platinum guarantee to you. Until next time, small business owners, you make the money, I'll make it make sense.